despite the wishes of the big thinkers, the world is short of energy. So energy prices, including conventional energy, will stay high for a very long time. Base metals prices will be high too, perhaps constrained by a recession between now and 5 years ago. But if you have an investment orientation that's geared to reality, that's geared to compounding, this is a very, very, very good time to be in the space.
Rick Rule is a highly renowned and seasoned investor, speculator, and founder of Sprott Global Resource Investments, a global alternative asset manager focused on precious metals and other commodities. According to Rule, a frequent speaker at industry conferences and interviews on natural resource investments, this is the best time to be an investor in the natural resource space. Rule believes the world is right on the precipice of a huge supply shock for various forms of commodities, including battery, industrial, and precious metals like gold and silver. During a recent interview with What the Finance Rule explains that the recent environment in the commodities and natural resource space brings to mind the opening line of A Tale of Two Cities by Charles Dickens. It was the best of times, it was the worst of times. Rule explains that it is the best of times for investors in the commodities space because the world has underinvested in productive capacity around natural resources for a very long time. On the other hand, costs are rising for the industry, and there's a global recession looming, which could significantly impact prices, at least in the short term. As a result of both opposing circumstances, Rule says investors are right to be cautious in the near term, but very bullish in the long term. For the Sprott Global Resource founder and CEO, the right approach toward investing in precious metals and other commodities and natural resources is to have a mid to long-term investment horizon. He adds that as the world aims for more globalization and urbanization, thus increasing the need for energy, metals like silver and copper will experience significantly increased demand. When that happens, Rule is certain that investors, governments, and regulators will finally catch on to how underinvested the space is, and that's when things begin to get really interesting. We will now bring you clips from the interview with Rule, who discusses the need to be significantly invested in metals from gold to silver, copper, and small-cap uranium stocks. Please ensure you stick with us to the end of the video, subscribe to the channel, and smash the like button for more videos like this. Thanks, and enjoy the video.
Precious metals tend to do well when people are concerned about the efficacy of savings products denominated in fiat currencies and their maintenance of purchasing power. Anybody who isn't concerned about the maintenance of purchasing power in long government bonds, I think needs their head examined. Quantitative easing, negative real interest rates, debt and deficits, and the impact on pensions from the degradation of principal in the long-term bond market, to me, guarantee, they don't suggest, they guarantee the diminution of purchasing power of savings products denominated in fiat currencies. I don't see any particular way around it. I'm not trying to say it has to happen tomorrow, but I'm trying to say that anybody who would, as an example, buy a U.S. 10-year Treasury paying, 4.8% in a currency where I believe the real purchasing power deterioration is closer to 7% than the CPI stated 3.9%, needs their head examined. They're bad at math. I wish what I was saying wasn't so. Gold is usually insurance against chaos, and my life is pretty good. I'm not looking forward to chaos, but I prefer to own it. As for the industrial materials, the simple ascent of humankind, the fact that there are 8 billion people on Earth, and the fact particularly that in the last 40 years, we have increased the material living standards of the poorest 3 billion people on Earth markedly, and allowed those people more access to material well-being, which means we've increased demand for industrial materials. As those trends continue, as there are more people on Earth, and as the people on Earth aspire to higher material living standards, the demand for all ranges of materials increases. The one where the increase seems most obvious is copper, not merely for electric vehicles, which might appeal to you and I, but rather for the billion people on Earth who have no access to primary electricity and will have it within 20 years. We have not made enough investment in copper to maintain the supplies for current demand, much less the increase in demand that I think we'll see over the next 5 years, 10 years, and 20 years. The public realization of the crisis until the crisis is on people. And I don't know what price level that will be. It's pretty obvious to me that the big copper deposits in the world, with a couple exceptions, sort of look like me, well past their prime, 70 years of age. Look at Bingham Canyon, the biggest mine in the United States. I think it's 160 years old. The Chuquicamata, biggest mine in Chile, 115 years old. The newcomer, Escondida, is 40 years old. Humankind is living on deposits that are well past their prime. And with the exception of things like Kamoa-Kakula, Ivanhoe's wonderful discovery and development in Congo, the world is woefully short of new deposits and new discoveries that will be required to replace these aging monsters. It is estimated by the U.S. Geological Survey that one Bingham Canyon a year needs to be discovered for the next 10 years. And in bad English, colloquial English, it ain't going to happen. Certainly, the result of high prices will be more exploration, more investment, and more conservation. Markets always work, but markets are messy. People don't like the way they work, and the impacts are always a lag. It is very true that the cure for low prices is low prices. Low prices stimulate demand and they constrain supply. Similarly, the cure for high prices is high prices. They stimulate conservation, they stimulate supply. But it takes years in a capital-intensive cyclical industry for the market to work on either the supply side or the demand side.
Taking a little detour, Rule focuses on precious metals like gold and silver and their role in the current high interest rate environment. He explains that investors, especially U.S. investors, are still caught up in the euphoria of the past 40 years. The pervasive normalcy bias means investors are not taking appropriate actions to protect themselves in this environment. Instead of taking shelter in gold, silver, and other hard assets in such moments of extreme uncertainties, more investors are being lured by high yields into bonds, primarily because they believe that the U.S. government will always be able to print itself out of such periods. Rule is certain that this behavior will continue until it's simply too late to make any notable difference. Let's get back to the interview.
I think we've been schooled in the last 40 years, which I think were the most benign economic period in human history, not to be afraid. Interest rates, both nominal and real, fell for 40 years. The benefits of globalization, the benefits of inclusion in the workplace, the benefits of demographics, all of those things conspired to make the last 40 years a wonderful time to be an investor and to be a consumer. I'm not saying that the world's going into a hell in a handbasket, but I think we're entering a period of time that's more challenging. When your expectation of the future is set by your experience in the past, our experience in the past has been pretty unchallenging. And I think as a species, or at least as investors, that we're less prepared for the future than we ought to be. Many times when I give talks like this, particularly to people of your generation who haven't really experienced the trying times that might have existed, say, in World War II or in the period of the 1970s, there is a sense that things only get better. And I suspect in the very long term, that's true. Things only get better. But there is also, I think, less fear, less experience. As an example, a younger audience might question my view of inflation. They may say, well, the CPI stated rate of inflation is barely at 3. What's the concern if I'm getting 5% in a treasury security? I would suggest that the CPI is a flawed measure of inflation. It's a consumer price index. It is, quote, hedonistically adjusted, which means that if the big thinkers that compile the index think that an item is more valuable than it used to be, that they adjust its relevance to the index. But much more importantly, Anthony, the CPI doesn't include tax. The largest expense suffered by most households in the developed world is tax. And the idea that they don't include tax in what purports to be a cost of living index is borderline fraud. it's insane. The way I informally calculate the depreciation of my purchasing power in US dollars is that the depreciation of purchasing power, including tax, means that my savings are losing purchasing power at about 7% compounded annually. The idea then that I'm happy about receiving a 5% yield in a currency that's declining in terms of purchasing power by 7% compounded means that my return on capital employed in savings is a minus 2% a year compounded, not particularly attractive. And you put your finger on really the death trap. Ability of portfolios for pensions and endowments, as an example, to meet their obligations 25 or 30 years hence. There's two problems there. The yield that they're getting from their long-term debt instruments is insufficient to maintain the purchasing power at the same time that the rising interest rates are lowering the capitalized value of the investments that they already have. So as an example, a university endowment that bought treasuries 3 years ago to yield 3% finds themselves now underwater in terms of the capitalized value of the corpus of their endowment, down by 30%. At the same time that the income is insufficient to maintain the promised payouts. This, for your generation, should be their primary concern.
One interesting part of Rule's interview is his take on copper, which is currently one of the world's most in-demand metals. Copper is very important in the drive to move the world away from fossil fuels toward renewable and alternative energy sources. The base metal has the highest conductivity of any non-precious metal and is used in very large quantities in the production of electric vehicles, windmill farms, and other renewable energy sources. By 2031, experts are projecting that the world will need over 35 million metric tons of copper per year, against an estimated 28 to 30 million metric tons of annual supply. That will create a shortfall of over 5 million metric tons. This will significantly drive prices and increase exploration and production in the space. Plus, a similar thing can be said for other metals, including silver, which the Silver Institute says is entering into a new era of increased deficits and supply shortfalls. What are your thoughts on Rule's predictions of long-term growth and developments for the commodities and natural resource space? Let us know what you think in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.